Investing can be one of the best ways to grow your money, but for beginners, it can also lead to fast losses if you're not careful. Many new investors jump in with excitement, only to make simple mistakes that cost them more than they expected. From following the wrong advice to making emotional decisions, these errors can quickly drain your money. Today, we will talk about how beginners lose money in investing fast. So before we get started, make sure to hit that like button. Also subscribe to my channel. 10. Investing without understanding anything. One of the biggest reasons beginners lose money is because they start investing without understanding the basics. They hear about an opportunity, see someone talking about profits, and jump in without knowing what they are doing. This creates a dangerous situation because they are making decisions without knowledge. For example, someone might buy a stock just because it is popular, without knowing what the company does or why the price is moving. When the price drops, they panic because they never understood the investment in the first place. Even simple knowledge, like understanding risk, market movement, and basic terms, can help avoid many mistakes. Learning before investing does not take much time, but it can save a lot of money. When you invest without understanding, you are not investing, you are guessing. And guessing usually leads to losses. 9. Chasing quick profits. Many beginners enter investing with one goal: making money fast. They look for opportunities that promise quick returns. They follow trends, jump into rising assets, and expect immediate results. But this approach often leads to problems. When something is already rising fast, it usually means many people have already invested. Entering at this stage increases the risk of buying at a high price. Then, when the price drops, beginners panic and sell at a loss. This cycle of chasing and reacting creates losses quickly. Instead of building steady growth, beginners keep moving from one opportunity to another without success. Real investing is not about speed. It is about patience and consistency. Trying to get rich quickly often leads to losing money quickly. 8. Following others blindly. Another major mistake is relying completely on others for decisions. Beginners often follow friends, influencers, or online advice without understanding the reasoning behind it. They believe that if something worked for someone else, it will work for them too. But every investor is different. They have different goals, experience levels, and financial situations. What works for one person may not work for another. Blindly following others removes your control. You don't know when to enter, when to exit, or why the investment was chosen. This leads to confusion and poor decisions. Learning to think independently is important. You can take ideas from others, but your final decision should be based on your own understanding. 7. Not diversifying investments. Putting all your money into one investment is one of the fastest ways to lose money. Beginners often do this because they believe one opportunity will give them high returns. But this increases risk significantly. If that one investment performs poorly, you lose a large portion of your money. This can be discouraging and difficult to recover from. Diversification means spreading your money across different investments. This reduces risk because not all investments move in the same way. For example, if one investment goes down, another might go up or stay stable. This balance protects your overall portfolio. Diversification does not guarantee profits, but it reduces the chances of large losses. 6. Letting emotions control decisions. Emotions play a big role in investing, especially for beginners. When prices rise, people feel excited and confident. They invest more, thinking the growth will continue. But when prices fall, fear takes over, and they sell quickly to avoid further loss. This behavior leads to buying high and selling low, the opposite of what successful investors do. Emotional decisions are often impulsive and not based on logic. They create a cycle of losses that can be difficult to break. Learning to stay calm and think clearly is essential. Investing requires patience, discipline, and the ability to ignore short-term emotions. 5. Investing money you can't afford to lose. Another common mistake is using money that is needed for daily life or emergencies. This creates pressure. When the market moves against you, you cannot wait for recovery because you need the money. This forces you to sell at a loss. Investing should be done with money that you can leave untouched for a period of time. This allows you to stay patient and avoid panic decisions. Using essential money increases stress and reduces your ability to make rational choices. Having a financial buffer before investing is important for stability. 4. Ignoring fees and costs. Many beginners overlook the impact of fees. Transaction fees, management fees, and other costs may seem small, but they add up over time. These costs reduce your overall returns. For small investments, fees can take away a significant portion of your gains. This makes it harder to grow your money. Being aware of costs and choosing low-fee options helps protect your investments. Small savings in fees can make a big difference in the long run. 3. Trying to time the market. Trying to predict the perfect time to buy or sell is very difficult. Beginners often believe they can enter at the lowest point and exit at the highest point. But in reality, market movements are unpredictable. Waiting for the perfect moment often leads to missed opportunities or poor decisions. Beginners may enter too late or exit too early. Instead of focusing on timing, focusing on consistency is more effective. Regular investing reduces the impact of market fluctuations. Trying to time the market often leads to stress and losses. 2. Lack of patience. Patience is one of the most important qualities in investing. Many beginners expect quick results. When they don't see immediate gains, they lose confidence and change their strategy. This constant switching prevents growth. Investments need time to develop. Short-term movements do not always reflect long-term value. Staying patient allows your investments to grow steadily. It helps you avoid unnecessary changes and emotional decisions. Without patience, even good investments can fail to deliver results. 1. Not having a clear plan. The biggest mistake is investing without a plan. Without a clear plan, decisions become random. Beginners don't know how much to invest, when to invest, or what their goal is. A simple plan provides structure. It helps you stay consistent and avoid impulsive actions. Your plan should include your goals, your strategy, and your time horizon. This keeps you focused and disciplined. A clear plan turns investing from guessing into a structured process. Losing money in investing is not unavoidable. Most losses happen because of simple mistakes that can be fixed. By understanding these mistakes and avoiding them, you can protect your money and improve your results. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.